This morning, the global sell-off is getting more intense, with technology playing a major role. I would like to introduce Wedbush Securities Managing Director, Dan Ives. We're looking at the Nasdaq, which is currently down 856 points and includes major laggards like Apple and Nvidia. How do you feel about the sell-off, Dan? Right now, it's a falling knife. Would you like to take the knife? Get your Nvidia keychain quickly for less than $10. We're offering a huge discount for the first 100 orders exclusively. Indeed, as far as investors are concerned, we are guiding them through this difficult time by examining the tech companies and the winners of what I think will be an AI revolution. Investors are undoubtedly contacting over the weekend and into Monday, attempting to ask, is this the end? Is the tech bull market coming to an end? It's not, in my opinion, as has been our strategy for the past 24 years in the tech industry. I think this is merely a great deal of worry and concern that will open doors for companies like Nvidia, Apple, Microsoft, and Amazon. Are you urging clients to buy on this when they call you this morning? We'll call it weakness, but it feels like more than that, boy. Yes, indeed. We've essentially been table pounding it when it comes to deciding which levels and names you want to hold. I think that this will be seen as more of an opportunity than catching a falling knife because of where the growth is. You look at the stats and earnings. I'm in Tokyo right now, and despite the Nikkei sell-off that is taking place globally, there is still a strong demand for AI throughout Asia. Today, we are communicating that to investors worldwide. Dan, I want to briefly put Apple on the screen because, in addition to the events of the previous day and the obvious job number on Friday, one of the pressure points was the announcement made over the weekend on Saturday that Warren Buffett had now formally cut his ownership of Apple in half. He remains the company's biggest shareholder. It appears that he has been attempting to raise money. He has clearly sold out of other equities as well, which I believe is contributing to the market's gloom this morning. However, this stock is currently down 7%. Why do you think that sale occurred? You see, Buffett was making some sales in the first quarter. The 50% sale, of course, was eye-popping, and I believe it attracted everyone's attention. Here, it will increase the pressure. It remains his most valuable possession. He is one of Cupertino's biggest fans. Number one has nearly twice as much buffet. We believe that if you look at Apple's most recent quarter, the outlook, and what I believe to be 270 million iPhones in a window of opportunity for an upgrade cycle powered by AI, you should buy Apple rather than sell it. Look, everyone pays attention to Buffett when he speaks, and for good reason. Despite some of the anxiety, this is not the time to sell Apple. This is a chance, in my opinion, especially as Apple enters what I consider to be a truly historic cycle of upgrades. Earlier, we had a somewhat macro conversation with Tom Lee about the direction of things and potential developments over the next month or two. In his opinion, I don't know, never might be difficult, get true stability until October. Therefore, even if you believe the market will soar in the days that follow, declining, it's extremely difficult in August and, historically, September before you truly know whether you're sea legs or not come October. Yes, look, I believe Tom has some very wise things to say. The upcoming months, particularly as we approach the election, will be a seatbelt time. However, if you consider the Fed cutting environment, a soft landing, and the foundations of technology, that's a time to buy technology. And I understand. After spending the previous 18 months in hibernation mode, the bears have triumphed in the last week or two. I understand, but if you look at high-quality, large-cap stocks in an AI, which I consider to be a once-in-a-40-year cycle, those are the stocks that are selling for less than $10. Get your Nvidia keychain quickly since we're offering a huge discount for the first 100 purchases you place here. And I believe that's the reason we're out here supporting one another during this difficult time. Now is not the moment to use the elevators. And this is, the profits that we observed were generally quite good for the Magnificent Seven, though occasionally people nitpick. As a result, what we're witnessing right now is most likely only a few contractions or some air escaping from the enthusiasm. What if it's a negative feedback loop and things do start to improve, and you receive both the earning side of things as well as the multiple side? Where could that bottom be, considering the Nasdaq is already down 10%? And the profits that we observed were generally quite good for the Magnificent Seven, though occasionally people nitpick. As a result, what we're witnessing right now is most likely only a few contractions or some air escaping from the enthusiasm. What if it's a negative feedback loop and things do start to improve, and you receive both the earnings side of things as well as the multiple side? Where could that bottom be, considering the Nasdaq is already down 10%? The self-fulfilling prophecy, that is. According to what we saw in profits as well as what I observe here. In Asia, on our checks on demand for the remainder of the year and 2025, I believe that the concerns are now unwarranted. Look, I believe the street will be fighting this ghost of a thing because of what might be around the bend. However, if you look at the fundamentals, they are good for tech, balance sheets are solid, and expenditure on AI again enters a cycle that occurs once every 40 years. Look, there will be losers in this. Consider Intel, which was clearly a disaster, as well as a few others, but when it comes to high-quality technology, big-cap technology, software, and semis, those are brands you own here, and you don't sell them in spite of the numerous nerves that will be going on throughout the world today. Our investment committee members are moving, or to use the word dislocation, yesterday to create new positions or expand existing ones. Now joining us from New Edge is Rob Sin. We've talked about not being Nvidia a lot over the past several months, which is hilarious, Rob. Although you have a variety of tech names, you didn't own this one until recently. Tell me why. You see, Scott, when we examined our portfolio, we found that it explicitly benchmarks against the rise of the Russell 1000. The average stock in the Russell 1000 growth was up 5% if you look back to the peaks. The index was up 21, but our average stock was up 15. Since the lack of ownership of Nvidia was the cause of all that underperformance, it begs the question of how you construct portfolios that are meant to behave in a particular manner within client accounts and ensure that you are not taking on what is known as tracking error or active risk. We looked through our portfolio yesterday after being underweight the stock for a while and discovered that a stock like O'Reilly, which is still a high-quality company, they have produced attractive returns and have many defensive traits, was trading at a very high PE in comparison to their history, and that same-store sales were beginning to slow. We therefore looked to that position in order to transition into a position similar to Nvidia, which is essentially improving quality, taking advantage of a recent value reset, lowering our tech underweight, and lowering our tracking error and active risk within our portfolio. Additionally, we thought that a half position made sense because they will be making money in the coming weeks. We didn't take a complete position, mind you, because we still believe there is some short-term danger here, whether it's because to the unwind, the interest rate spike we've seen, or additional jobs data that could frighten markets. We do believe that there may be a chance to purchase more at lower prices, but the takeaway for investors is that you need to be surgical and micro-focused when you see volatility. And as this volatility continues, I would imagine that we will be making several adjustments to improve the quality of all 5 of our strategies across all of our portfolios. Right now, none of us can tell if this is an unwanted growth scare or a welcome cooling. If the latter, we will have several opportunities. The important thing is to get clients ready to take action. I'd like to share with you another unusual activity we did. We were long duration a month ago. I've never witnessed a bond move like the one we've witnessed here. And since it's gotten so unappealing, we've closed that out and are currently cutting duration. According to Rick Reeder and all of the committee members, there is a lot to do, and if you're ready for it, volatility can lead to opportunity. Get your Nvidia keychain quickly for less than $10. We're offering a huge discount for the first 100 orders exclusively.